Everyone thinks silver is exploding because of speculation. History shows something more dangerous. Silver doesn't break financial systems. It exposes where they were already cracked. Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. When people see silver spike, the first instinct is to ask one question: how high will it go? But applied financial history asks a better one: why is silver no longer behaving like a normal commodity? Because silver isn't just metal. It sits at the intersection of money, industry, and trust. And when something sits at the intersection, it becomes a signal. Historically, silver has always played this role. It was money before paper. It was trade before banks. It was value before promises. That matters, because silver reacts before narratives change. In every major monetary transition, silver moved first. Not gold, silver, because silver lives in the real world. Gold can sit quietly in vaults for decades. Silver can't. Modern financial markets treat silver like paper, futures, ETFs, synthetic exposure, an industrial necessity. That's where the current stress begins. For years, paper silver markets worked because physical supply acted as a buffer. If demand rose, metal appeared. That buffer is now thinning, not disappearing overnight, thinning, and thinning is more dangerous than collapse. Industrial demand doesn't respond to price the way investors do. Solar panels don't care about RSI. Electronics don't wait for pullbacks. Defense systems don't substitute copper. When silver is needed, it's needed now. That makes demand inelastic. Paper markets rely on elasticity. Sellers appear at higher prices, arbitrage closes gaps, confidence restores balance. But what happens when physical buyers done sell? The model breaks. Not explosively. This is why arbitrage gaps matter. They're not about profit. When Shanghai prices drift from London, it's not a trade issue. It's a trust issue. History shows that paper markets fail in the same way every time. Not when prices rise, but when delivery confidence erodes. People don't panic because price is high. They panic when delivery is uncertain. This already happened before. In the 1960s, the London gold pool collapsed, not because gold was scarce, but because confidence in fixed pricing vanished. Once belief broke, price rediscovered reality rapidly. Silver is following the same script, slower but deeper. What we're seeing now is not silver going up. We're seeing silver stop listening, stop responding to futures pressure, stop respecting paper suppression, stop caring about narratives. That's not bullish behavior, that's structural stress. The system prefers to explain this as speculation because speculation is controllable. Belief collapse isn't. Notice the language: retail frenzy, temporary imbalance, seasonal demand. These phrases don't explain reality, they manage perception. Applied financial history teaches us to watch where explanations get defensive. When systems fully understand a phenomenon, explanations are calm. When systems are uncomfortable, language becomes repetitive. That's what's happening now. Silver isn't breaking the system. It's showing where the system already relied on assumptions. Assumptions like infinite liquidity, interchangeable paper, and metal time-based delivery doesn't matter. Those assumptions worked. The real risk isn't a silver spike. The risk is contagion of disbelief. If silver paper can't be trusted, what else can't? Other commodities, other derivatives, other promises? History shows disbelief spreads faster than inflation. This doesn't mean collapse tomorrow, and trust repricing always begins with assets that touch reality. Silver, energy, food, not tech stocks. That's why silver moves before headlines change. It reacts to stress the system hasn't admitted yet. The most dangerous phase isn't the spike, it's the normalization. When people say, silver always does this, that's when signals get ignored. History shows signals don't repeat forever, they escalate. Silver is not predicting the future, it's reflecting the present. A system stretched between paper promises and physical limits. Understanding this removes panic, because this isn't chaos, it's process. And processes can be studied. Applied financial history doesn't ask, will silver hit $200? It asks, what changed in the system that made silver stop behaving? That question matters far more. If silver were speculation, banks would be relaxed. They aren't. If silver were hype, arbitrage would close gaps. It hasn't. If silver were noise, narratives wouldn't sound nervous. They do. Silver isn't loud, it's honest. And honesty makes fragile systems uncomfortable. If you want to understand money beyond price charts, subscribe to Wheelixon.